Let's start with the operating cash flow. The idea is it's nothing but annual profit from sales. So there is operating cash flow for year 1, for year 2, for year 3, and so on, with the last operating cash flow that needs to be calculated being for the final year of the investment project. However, operating cash flow is not the same thing as net income. So what exactly is it? How do we calculate profit for each year? If you go back to, accounting, right? How would accountants do it? They would basically build you an income statement, one income statement for each year, for year 1, for year 2, and so on. What does a standard income statement look like? The first row is the sales revenue, the money that would be coming in from selling our product. And then everything that follows in the rows underneath is different expenses. First we subtract the costs of goods sold, then we subtract depreciation. After subtracting these two items from the sales revenue, we get EBIT, which stands for earnings before interest and taxes. Then we subtract interest expenses on loans, which gives us taxable income, or earnings before taxes, EBT. Then we multiply that by a certain corporate income tax rate that, is applicable to this company. And after subtracting taxes, we are left with net income. So this is how accountants calculate profit for every year. However, there are a couple of things that we finance people are doing differently. First, remember from the earlier slides, interest expenses on loans are considered irrelevant for capital budgeting decisions, right? We are not going to use interest expenses in our net present value calculations, right? The second thing that we are going to be careful about is net income. Is this really how much profit we make? Well, not exactly. It's actually understated. There is one item in this list of expenses that is not a true expense. It's a so-called non-cash item, and that's depreciation. Depreciation is not an actual cash expense. It's only there because of how we need to be calculating taxes correctly. It's only there for tax purposes. And so because depreciation is something we never spend, we need to add it back to correctly calculate the profit for the year. And this is how you can find the operating cash flow. So you can take net income, the last row of a standard income statement, and add the depreciation amount back to it. The textbook's definition of the operating cash flow is EBIT, earnings before interest and taxes, plus depreciation minus taxes. So by adding depreciation back to EBIT, we are essentially saying that we just have sales revenue minus cost of goods sold. And then the only thing that we subtract, the only other thing that we subtract is taxes. We are not subtracting interest expenses. Let's look at the following example. Let's say we are considering a new investment project, right? And we are now interested in calculating the operating cash flow for the first year of this project. Here's what we know about the first year. Over 1 year, a firm's sales revenue is expected to equal $50,000. Production costs would equal $30,000. Depreciation expense for tax purposes would equal $8,000, and corporate income tax rate is going to be 34%. How would you calculate the operating cash flow? Well, let's build the entire income statement first, and then we'll just pick the items that we need to follow the formula from the previous slide to find the OCF. The income statement would need to start with the $50,000 in sales revenue. Then we subtract production costs, minus $30,000. Then we subtract depreciation, minus $8,000, which gives us the earnings before interest and taxes. That's $12,000. Right? $12,000 is $50,000 minus $30,000 minus $8,000. Then we need to subtract the tax amount. We are given a 34% corporate income tax rate. If we multiply 34% by the taxable income, which is the EBIT of $12,000, we would get $4,080. After subtracting $4,080 in taxes from the taxable income of $12,000, we get the net income equal to $7,920. Now, how do we find the operating cash flow? Following the formula from the previous slide, we take EBIT, which is $12,000. We add depreciation back, so plus $8,000. And then we subtract taxes, minus $4,080. This gives us $15,920. This is the profit, the true profit that we would be earning over the first year of this investment opportunity.